Welcome back to the Dividend Diplomats YouTube channel, everybody. You know us by now, Lanny, Bert, the Dividend Diplomats. So today, we're going to talk about a stock that we've invested to that is sitting at a nice 26% loss in my portfolio. But the question we're going to be asking is, why is it? What's happened? What are the earnings telling us? We're going to run them through our screener. And then more importantly, what are we going to do from here? That's going to be the key piece. We're going to lay out three options to figure out how the heck we should fix this position.
What you gonna do, brother, when Stanley Black & Decker runs wild on you? Bert and his wife have been buying Stanley Black & Decker. It's been a while since you've purchased them, actually.
Yeah.
And
Spoiler
you might be
for
down,
Thursday's video.
You might be down 26% of. And,
yeah, but it's number one in our heart, no matter what.
Right. But the yield now is at a spot that hasn't seen these levels since this certain time period about 13 or 14 years ago.
Yeah, that's right. And that's really what kind of I saw a chart of Stanley Black & Decker's dividend yield compared to where it was in the financial crisis. Those were the two tops there. And then it went down into a valley. The yield was typically between 2 and 2.5% for the next decade plus. Spiked up at the beginning of the pandemic with every other companies when its price fell, came down. And now, after a tough 2022, the yield is solidly over 4% and has been for quite some time. But as we all know, you don't make your decision just purely based on dividend yield, Lenny. You don't get caught chasing yield. You don't get caught going over the highest yield, because surely if that were the case, we wouldn't be looking at Stanley Black & Decker. The reason why we continue to think about Stanley Black & Decker is because they're not just a dividend aristocrat. They are a dividend king. A dividend king is a company that has increased its dividend for not 1 year, not 2 years, but 50 plus years. So this isn't the first time Stanley Black & Decker has faced adversity and faced a tough economic cycle. They've done this before. They've increased it through the financial crisis. They've increased it through the tech bubble bursting. They've increased it through many other times. So that's why, with a strong yield, their dividend king status, we want to peel back and look at what the heck is going on with Stanley Black & Decker.
Exactly. Now, guys, this is a dividend king. They've been through all this trials and tribulations before. They may be slashing guidance. They may be tighter on the dividend payout ratio right now. But you've got to think that management knows what they are doing and has gone through this before. Just bring out that playbook, right, Bert?
That's right. And they do own strong brands, which has helped keep them relevant throughout the years. They own DeWalt, Black & Decker, Stanley, obviously, Craftsman, to name the few. These are big time brands. They're the number one world leader in the tools industry. They're in 60 countries. They're trying to make a major play in the electric car sector, all of which are stats from their website. So that's what's exciting about the company. They're not going to go away just because of the tough times. Now, as Lanny said, they've cut their earnings guidance twice this year. In fact, earnings expectations are half of what they were when we entered 2022 because of a slowdown, because of some issues with currency, because of future revenue and earnings expectations. They also have some debt on their balance sheet. So I'm not going to pretend like they're not a leveraged company, which always adds pressure in the face of lower expectations and potentially lower cash flow. So there are a lot of negative headwinds facing the company today and a lot of things that they got to continue working through. The question is this the time to buy while they're at their lowest and looking into the future and seeing? I guess that's why we're going to run them through our stock screener here to find out what exactly is going on with Stanley Black & Decker and what do their metrics look like today.
That's jumped right in, Bert, trading at $79.23. That forward EPS right now is looking a little interesting at only $4.64 for Stanley Black & Decker.
Yeah, that was after they slashed the guidance once again. When they cut the guidance, they dropped it to a range of between 415 and 465, which was lower from the 5 to 6, which was lower from the 9 to 10 that was earlier in the year. So yeah, it's in the lower end of that range for sure.
So that price to earnings ratio is still only 17 right now. Obviously, with it all going down, stock price and earnings per share projections lower than the S&P 500 currently right now. Not the most undervalued stock out there, but definitely not overvalued.
That's right. And the PE ratio has jumped from where it was early in the year because obviously when you slash earnings and you slash the denominator in the PE ratio equation, the PE ratio is going to jump up. Looking at the dividend, their annual dividend is $3.20. On that forward EPS guidance of 464, that's a payout ratio of 68.97%. So it is above our 60% today. And interestingly, when you go through the company's latest investor release from Q3, it is above the company's target payout ratio to shareholders. In the long run, they say they want to return 50% through dividends and share repurchases, and their target payout ratio into the long future is well below this rate, 30 to 35%, once they can kind of correct some of these things. So they're running hot right now. They're running hot right now at the payout ratio. So I'm not going to expect very many future dividend increases, but they don't seem like they're at the point yet where they're ready to cut that dividend and give up that dividend king status.
I don't see this legacy company not increasing their dividends. So I think you'll still get an increase, Bert. And they'll keep extending it. It might be like the quarter of a penny.
Yeah.
That's right.
Yeah, they might run the Emerson Electric playbook for a few years here, those terrible dividend increases.
Yeah. I've got Emerson on one hand and I've got 3M on the other line. Hold on a second.
Yeah, it's like both of those, we're going to run it. But the next, 6 months are going to be very telling, because you can only hang on for so long. They still have plenty of room. They have 30% buffer here between the dividend and earnings per share, where the dividend is still covered by current earnings. So it's going to be very critical watching what is happening with Stanley Black & Decker through 2023.
Exactly. And again, increasing that dividend for over 54 years at an average rate of almost 6%. Obviously, with the downward pressure on the stock prices, caused that dividend yield, that juicy dividend yield, that dividend income that everybody wants to live off of right now is now over 4%. Bert, historically, what is that benchmark dividend that they usually have?
Between 2 and 2.5%, where it's been the last decade. So they're trading way, way above it.
Wow. So you have to think, with all these cost savings plans that they're about to endure, trying to save billions of dollars by 2025, trying to save $1 billion in annualized savings by the end of 2023. You have to think they're trying to right the ship, cut cost, increase margin again, and keep that dividend flowing.
That's right. And that's why we're still here today looking at them and running them through. Now that we're through the metrics, we'll put them up here again. We're going to move into here of like, what do we want to do? So let me share where we're at today. My wife owns 31.336 shares at an average cost basis of 107.84. So we put in about 3,400 here. Current market value is at 24.83. So again, we're at an unrealized loss of almost $900, down 26.5%. Luckily though, with owning 31.336 shares, we crossed the $100 total annual dividend mark for Stanley Black & Decker. So we receive 25 each quarter. At this current price, we're getting 1.26 shares every year via DRIP. It's pretty cool to at least hit that 100 mark for Stanley Black & Decker.
Now, what's going to be cooler though is hitting 50 shares or 100 shares for you, Bert.
That's right. So that's where we're trying to figure out what we want to do here. Based on the metrics, they're not the cheapest, but they are undervalued significantly compared to historical marks, especially when you see that yield pop up. So here are my three choices. Here are the three things that we're going to want to do here. I kind of laid them out. Number one, you hit it right there, Landon. You get to 50 shares. To do that, we need to buy 18.6 more shares and invest a little under 1,500 to do so. That would bring our average cost basis down $10 per share. So our average cost basis wouldn't be 107.84. It would be 97.16 at the current prices. That would juice our annual dividend income to 160 from Stanley Black & Decker and give us over 2 shares annually via DRIP.
Interesting. So that's option one. Yeah. Now, what if you just want to get to $100 per share on the cost basis?
Yep, that's right. So we're saying we want to bring down the cost basis, keep lowering it while it's down, but we don't want to go ham and get to 50 shares. To get to $100 cost basis per share, again, we're currently at 107.84. We need to add 12 shares. So that would be adding $950 in new capital, and that would bring our average cost basis to 99.92. Our forward dividend income from the position would be 138.68, and then we would get 1.75 shares of DRIP.
Now, Bert, what if you pulled out the J&J, the King of Kings, Johnson & Johnson strategy, and started acquiring one more share per week?
All right, I like it. So then we would say, let's just keep nibbling, keep doing it over time. There are a few more weeks left in the year. Let's just say we do this for the next 5 weeks. We have 5 shares via 1 per week here. That'd be just under $400 of new capital. Bring down the average cost basis to 103.90, 116.28 dividend income, drip 1.46. So that's obviously the light option. Option 2 is the medium option. We're only getting 12 shares. Then option 1, screw it, let's get to 50, 18.6 shares. So those are the 3 options. And I'm still looking at this. I don't exactly know which route I want to go. But I can tell you this week, I can easily start with option 3. There's no reason why I can't start with option 3, right? You can keep going, keep adding 1 share at a time, see what's going on, get a feel for it. You know, the weeks I want to put more money in the market during the week, 2 more shares of Stanley Black & Decker. I can keep building. Soon, before you know it, maybe I'll cross off option 2 just because we were just trying to put as much money as we can and reach financial freedom. And then once you get to 2 and you're like, hey, it's only going to be 6.6 more shares to get to 50. There's a good chance I'll probably be able, let's just get to 50. But let's see.
Hey, let's see. Because SWK was down about 2.25 this past week on, ending December 9th. So Bert, do you think there's more room to go down on Stanley Black & Decker?
Yeah, I mean, I don't think there's going to be any economic news that's going to be great here for Stanley Black & Decker. I guess the big question is, this is going to be a little bit of not earnings management, but much of this double earnings cut was just to take as much of the negative news as they possibly can in 2022, lower the expectations to the point where the stock price is already beaten down. So every subsequent earnings release in 2023 is showing stronger results and getting the positive momentum back. I can't rule that one out of the equation because I know a lot of banks do that. Jamie Dimon also likes to do that. He likes to get out in front of the bad economic news and juice up the provision a little bit to cut down earnings so that can release it later when it's a better time. So this is a strategy, and I could easily see that being the case for Stanley Black & Decker too.
Yeah, they wouldn't be the first company to make it very bad and rough just so they can, again, the whole under the promise, over deliver.
Yeah. So everyone, let me know what you think. What option would you pick for if you were me? Would you also then just work from 3, 2 to 1, start low, medium, and then high and just get to the 50? Or would you avoid Stanley Black & Decker altogether going forward? Please, I'm very interested. I don't have a finished decision yet. So I can't wait to read the comments and get your thoughts on this dividend stock.
Guys, let us know what other Dividend Kings you're buying right now. Have you been inching into Stanley Black & Decker? I can't wait to see what option you think Bert should go down here, acquiring shares of this being down Dividend King. Thanks for bearing with me again on my sore throat and congestion and you name it. I appreciate that.
Let's get every dollar we can in the market. Let's finish 2022 in style. Come on, everybody. Let's freaking go.
That was Bert the Hurt and Lanny from the Dividend Diplomats, over and out.